Welcome to the deep dive. Today we're tackling a really interesting one, the Q2 FY26 results for Bajaj Consumer Care Ltd, BCCL.
Yeah, it's more than just numbers, isn't it? This is a company in the middle of a huge internal shift. They're redoing distribution, bringing in acquisitions.
And all that while juggling, big market shocks and even a surprise government reform right in the same quarter.
Exactly. It's quite the mix.
So our mission today is to unpack how BCCL pulled off this significant margin expansion despite all that friction. Where are things clicking and where are the, let's say, growing pains still evident?
Well, fundamentally, the quarter really shouts profitability.
Hmm.
Management found the levers, pulled them hard. It feels like they're building that financial foundation first.
Right. Setting the stage for maybe volume growth later. Okay, let's dive into that headline number then. The margins. That's what really leaps out, wouldn't you say? Standalone EBITDA margin, up 500 basis points year on year, hit 20.5%.
Yeah, and just a quick reminder for everyone, 500 basis points, that's a full 5% improvement in their core profitability margin. That's a huge operational lift in just 3 months.
And we saw similar strength on the consolidated side too, right? Over 400 basis points up, reaching 18.6%. So what was under the hood? What drove that?
The real engine here was the gross margin improvement. That shot up by, almost 690 basis points. Massive. And management was pretty clear. This wasn't accidental. It came down to 3 specific things they did.
Okay, let's break those down. That sounds like the core strategy for the quarter.
First off, they saw the full impact of strategic pricing they'd actually put in place back in Q1. Simple lever, charge a bit more where they could.
Makes sense. What else?
Second, and this is a bit more nuanced, they actively managed the portfolio mix, essentially pushing the higher margin products harder. So even if you sell the same number of things, you make more money if they're the right things.
Okay. So steering consumer choice towards profitability. Got it. And the third?
Just good old internal productivity actions. Think supply chain tweaks, better buying, tightening belts internally. You put those 3 together, pricing, mix, and efficiency, and boom, you get that nearly 7% jump in gross margin.
And that flows right down to the bottom line, obviously. The profit after tax numbers look really strong. Standalone PT grew almost 30%, 29.7% to be exact. That's 43 crores.
Yep, that margin fuel really powered it. And consolidated PD was even stronger, up 32.8%, hitting 42.3 crores. It sends a clear signal, doesn't it, that BCCL is building a much more profitable base.
All right, let's shift from the spreadsheets to the streets, so to speak. Distribution. This feels like the other massive story here, especially with Project Arrowhand.
Absolutely. Arrowhand is their big bet on overhauling their go-to-market strategy, increasing direct reach, shaking up the network, and the channel performance this quarter. Definitely a mixed bag. It shows where Arrowhand is working and where it's, causing some disruption.
The headline for general trade, the smaller local shops look pretty decent. 5% growth year on year. That's a solid recovery.
It is, but you have to slice it thinner. Look inside GT and you see this stark urban versus rural split. Urban GT, strong double-digit growth. That's where Arrowhand is delivering right now. They added, get this, over 38,000 new outlets to direct coverage just this quarter.
Wow, 38,000. That's huge expansion.
It is. Direct retail, wholesale, it's working in cities.
Okay, so if urban is booming and they're adding all these outlets, why only 5% growth overall for GT? What's dragging it down?
That's the rural piece. Management called it a work in progress. They were pretty upfront that the Arrowhand transition has been disruptive out there. It created this big gap. They mentioned like 600 to 700 basis points difference in volume growth between urban and rural.
Oof. So rural is feeling the pain of the changeover.
Exactly. Short-term pain for hopefully long-term gain. Urban's getting the benefits now. Rural's still in the transition phase.
It's a big strategic play, high stakes. But these kinds of issues don't seem to be affecting the more formal channels, do they?
No, not really. Organized trade, the modern trade, supermarkets, and e-commerce, that just keeps powering ahead. Strong double-digit growth again, over 20% easily. It now makes up 31% of their total business. Quite significant.
Right. Now, speaking of channel disruptions, there was that weird external hit in September, wasn't there? Something about GST.
Yeah. That affected the institutional channels, CSD, CPC, like canteens. The government's GST reform kicked in, and it caused this temporary halt. They called it a steep decline. Basically, sales went to near zero for a bit.
Why? Just because of the tax change?
Yeah, those channels had to clear out all the old stock, taxed at the higher rate, and then bring in new stock at the lower rate. So you had this pause while that whole destocking and restocking process happened. A temporary blip, but a sharp one.
Okay, let's talk product, the main engine. Almond Drops hair oil,
Ah.
ADHO. This is where we see that central tension play out, right? Revenue growth was double-digit. Good news. But volume growth was pretty much flat.
And that is the key discussion point, isn't it? You've got great profit numbers, but the core brand isn't actually selling more units yet. It really highlights that the distribution piece, especially getting rural firing properly, is still the limiting factor for volume.
So how did they push revenue up so much with flat volume? You mentioned pricing earlier, but was it just that?
It was a combination. Yes, great pricing was part of it, but also this mix change thing was really important for ADHO. They nudged people towards the larger, more expensive packs. So the average amount spent per purchase went up.
Ah, okay. Bigger bottles, higher value.
Exactly. And they also saw LUPs, those little low unit price packs, the sachets making a comeback, which helps penetration. But the real value driver was shifting the mix towards those larger SKUs. It's smart revenue management.
And they threw a lot of marketing weight behind it too. Didn't they increase TV spend significantly?
Oh yeah, a 50% increase in TV investment year on year. They pushed something like 2,100 GRPs.
Okay, translate GRPs for us quickly.
Gross rating points. It's basically a measure of advertising impact or reach on TV. 2,100 GRPs means they were hitting the airwaves hard for ADHO. But it wasn't just TV. Their digital stuff was quite clever.
Right, that hair quality index thing, the HQI campaign. Tell us about that.
Yeah, this was interesting. They used AI, integrated with live weather data, to give users a personalized analysis of their hair health via digital filters. It's advertising, but it provides some utility, some engagement.
Did it work?
Seems like it. They reported a 66% engagement rate, which is pretty high.
Well,
And importantly, it led to a 9% increase in add-to-cart actions online. So connecting that digital fund directly to potential sales.
okay, interesting. Now let's switch over to coconut oil, CNO. That category looked much quieter, only 3% revenue growth.
Yeah, C&O was a different story entirely. This is all about input costs. Copra, the raw material for coconut oil, the price more than doubled, just
Yeah.
shot up.
Doubled.
Yeah. So BCCL had to push through some pretty steep price hikes on their pure coconut oil. And naturally, consumers push back a bit when prices jump like that.
So what did they do strategically? Just raise prices and hope for the best?
No, they reacted pretty quickly. They saw consumers potentially shifting away from the expensive 100% pure stuff
Yeah.
towards value-added coconut oils, the FENEs, which are often blended or enriched, but more affordable.
So they launched something new.
Exactly. They did a rapid launch of Bajaj Gold enriched coconut hair oil around September, October. It's about managing profitability, keeping consumers in the franchise even if they trade down slightly. It's a portfolio play.
Right, managing the portfolio. Let's talk about adding to that portfolio. The acquisition of Vishal Personal Care, VPCL, the Burra brand owner. They brought that in back in May. How's the integration going?
Seems to be progressing pretty well. Barga itself chipped in about 14.5 crore to the top line in the quarter, growing at a healthy 11-12%, and its margins are solid, mid-teens EBITDA.
Yep.
The full integration is planned across this fiscal year, FY26.
Did they test how it would work together?
Yes. They ran a pilot in one state, fully integrating the sales and distribution for both BCCL and Barra products. The feedback was very positive. Looks like BCCL's network can help Barra, and Burra's presence might open doors for BCCL too. So the synergy seems real.
Okay, good signs there. Now, back to that big external shock we touched on, the GST rate cut from 18% down to 5% on what? Almost everything they sell.
Pretty much, yeah, on nearly 100% of the portfolio. And long term, you're right, this should be a huge positive. Lower taxes generally mean lower prices, which should stimulate demand, volume growth eventually.
But you mentioned short-term pain.
Definitely. That whole channel destocking process we talked about for the CSD channel, that happened across all trade channels in September because of this GST change. Wholesalers, retailers, everyone had to clear old stock, wait for new lower tax stock. It put a temporary brake on sales.
And they quantified that impact, didn't they?
They did. They estimated it cost them about 3% of their total Q2 revenue. Yeah. Just gone because of that transition process in September. A one-off hit, but still, it impacted the quarterly number.
Okay. One last area that seemed to struggle was the international business, down 26% year on year. That's quite a drop.
It was a significant drag, yeah. It seems to be a mix of factors, some external headwinds, particularly in the U.S. and what they call rest of world, but also some internal challenges related to distributor transitions in key regions, the NIA region specifically.
So not all markets were down.
No, Bangladesh actually held up okay, grew 8%, so it shows it wasn't a universal collapse. But key markets had issues. Nepal was also mentioned as being down temporarily due to some political instability there. So a bit messy internationally this quarter.
Zooming back out to the financials, beyond the P&L, their actions around capital seem to show some confidence, like the share buyback.
Absolutely. They completed that buyback in October, bought back nearly 4.7% of their shares, about 64 lakh shares, at 290 each. That's a 186.6 crore cash outflow.
Which they funded how?
Entirely from retained earnings from their own cash reserves. That signals financial strength, and it's a clear move to return value to shareholders.
And achieving those great margins we discussed earlier, they had to wrestle with some pretty volatile raw material costs, right? It wasn't easy.
Not at all. It was definitely a mixed bag on costs. Something called LBO, linear alkyl benzene. Its price actually fell about 7%, but other key materials, grouped as RMO, saw a 40% inflation spike. And we already talked about copra prices doubling.
So they achieved those margins despite cost pressures, not because costs were falling.
Exactly. It really underscores the impact of those pricing, mix, and productivity actions we discussed earlier. They had to actively fight against inflation.
And speaking of productivity, there was that small, kind of interesting detail about buying flats.
Yes, the related party transaction. They bought 25 crore worth of residential flats from a group company. The rationale given was cost savings, setting up a corporate guest house in Mumbai to cut down on hotel expenses for staff travel.
Okay, makes sense. Another little piece of that efficiency puzzle.
It fits the narrative, yeah.
Yeah.
Constantly looking for ways to optimize.
So with this stronger profitability base, this ongoing distribution overhaul, what's the big picture aspiration now? Where do they want to go?
Well, management was quite open about it. Historically, their revenue growth, the CAGR, has been in the low single digits. They're now aiming much higher, getting to a double-digit revenue growth, CGR, over the medium to long term.
And crucially, how do they plan to get there? More price hikes.
No, they stress that it needs to be driven primarily by volume and improved mix, not just relying on pricing power, which, you can only use so many times. They want sustainable volume-led growth.
Okay, so putting it all together, Q2 is about fixing the plumbing, boosting profitability, making big investments in Arahan, the acquisition, marketing, all while navigating these external curveballs like GST. They used price and mix to buy time while they sorted out distribution.
That sums it up pretty well. They successfully shored up the financial side. Now the focus shifts to reaping the benefits. The lower GST should help affordability. The new outlets from Arahan should start delivering volume, especially once rural stabilizes. Those structural gains are what we should see coming through in the next few quarters.
Which brings us perfectly to our final thought for you, the listener. We saw ADHO, the core brand, post double-digit revenue growth thanks to pricing and mix, but flat volumes, even with that huge 50% advertising boost. So the question is, how quickly can Project Arahan, particularly in those work-in-progress rural areas, actually turn things around and start delivering sustained double-digit volume growth for ADHO? That shift from profit focus to real volume momentum, that's the key thing to watch in the coming year, wouldn't you say?